Ethereum's price chart surges relentlessly, climbing from about $1,400 in April to nearly $5,000 by late August 2025. It briefly recorded a new all-time high of $4,945 in August 2025. Eclipsing its November 2021 peak of $4,878, each new top adds a chapter of drama. By mid-2025, the scene felt almost cinematic. Traders compared it to rocket launches and tidal waves. Whispers of a Federal Reserve pivot mixed with the roar of social media hype. It was as if the market's pulse had flatlined all year, then suddenly surged to life. This isn't just a market rally, it's a full-blown thriller in the crypto world. And every viewer is asking, what's driving this breakneck ascent? The first wave comes from institutions and big holders. US spot ETFs, once only hypothetical, now hold roughly 6.7 million for, nearly double their April balance. These funds have been on a buying spree, pouring nearly $10 billion into Ethereum over July and August. Even as September dawned, that torrent continued. So value data show about $640 million more entering these ETFs last week. Meanwhile, crypto's largest wallets, the whales, have been devouring more. Addresses with 10,000 to 100,000 ETH added another approximately 6 million coins in recent months, lifting their collective hoard to a record 20.6 million. It's a sign that smart money is entrenched. Between institutional and whale buying, a massive chunk of supply is effectively spoken for. In plain terms, that means new buyers must jostle for a shrinking pool of coins, which inherently drives prices higher. On the other side of that coin, Ethereum's own economic design is squeezing supply. CryptoQuant data via Dune Analytics show 36.2 million. ETH are now staked, roughly one-third of all ETH in existence. That's about 2.5 million more coins staked since May. Picture 1 out of every 3 coins on the planet being locked away. Those staked ETH earn rewards a few percent per year, incentivizing holders to keep them locked rather than sell. The circulating float available for trading is shrinking fast. In practical terms, buying pressure is running headlong into a lower supply. Weekly issuance of ETH is now tiny compared to the massive burn in lockup. On busy days, the net supply can even shrink. Analysts emphasize that this structural deflation, one-third of coins off the market, is profoundly bullish. Each new validator, each extra block of staked ETH, is like pulling another bucket out of the supply. The market is tightening from the supply side, even as demand roars. Meanwhile, Ethereum's network itself is humming like never before. On-chain activity has soared to unprecedented levels. In August, daily transactions hit roughly 1.7 million, far above any prior cycle, and about 800,000 unique addresses were active in a single day. Think of every one of those transactions as a tiny heartbeat of this digital economy. Trades, loans, mints, and burns. Decentralized exchanges, lending protocols, and NFT marketplaces are all working overtime. Stablecoins shuffle hundreds of billions in circulation, much of it on Ethereum. Every corner of the ecosystem is contributing to a record daily count of over 12 million smart contract calls. This isn't mere hype, it's real economic throughput. CryptoQuant notes that this explosive usage underscores Ethereum's evolution into a programmable financial settlement layer. For a new economy, and each of those millions of calls and transactions contributes to Ethereum's fee-burning narrative. More throughput means more fee revenue for validators and more ETH removed via the burn mechanism. It's almost like a tax on activity. The busier the network, the larger the toll collected. That toll is then permanently burned, reducing supply. CryptoQuant and others argue that this is turning Ethereum into a cash flow generating asset, more like infrastructure than a mere speculative token. With every DeFi swap or NFT sale, a bit of ETH vanishes from circulation, reinforcing scarcity. In a sense, every on-chain dollar move chips away at the total ETH pile. Analysts even highlight that this effect has become substantial. Some call it Ethereum's ultrasound money moment, where its supply shrinks with use. No wonder Ethereum now underpins the vast majority of crypto minus 158 of the top 200. Tokens live on its chain, about 75% of them. It's literally the backbone of nearly the entire ecosystem. In practical terms, this means Ethereum's price is increasingly tied to real usage. The more valuable the network, the more ETH is locked or burned, creating a potent cycle of demand and deflation. Given all this demand and decreasing supply, selling pressure has nearly evaporated. CryptoQuant charts show net inflows to exchanges have collapsed. Around mid-August, roughly 1.8 million ETH per day flowed into exchanges. By early September, that was down to approximately 750,000. That's a radical shift. With far fewer coins on exchanges, the market has one clear thread. It's mostly moving up, unless demand completely vanishes. Think of it like a river whose current only goes one way because the floodgates closed on all but a trickle of sellers. Every small buy order has begun to push the price significantly. Long-term holders, the whales and institutions, are clearly preferring to hold rather than cash in their gains. This setup creates what traders call one-sided tape. Unless something hits the sell button, price tends to drift higher. Of course, if the flood of selling ever returns, it could reverse sharply. But right now, the sellers are sitting on the sidelines, giving the bulls a clear stage. Even so, every rally has a climax, and Ethereum faces a major hurdle ahead. CryptoQuant identifies a key technical threshold around CryptoQuant, $5,200, essentially the upper band of the realized price range. In past bull runs, Ethereum repeatedly stalled near this level late 2020. It's late 2021, because at that price many holders would have enormous profits and tend to sell. It's like an invisible ceiling built by market psychology. Now, ETH is right below that zone again. If it can blast through $5,200 decisively, it could be the point where the market truly breaks free, a dam break moment unleashing an avalanche of buying. On the other hand, if it gets knocked back, it could signal that the rally has peaked and needs time to consolidate. Everyone's watching. A convincing breakout could send Ethereum to new all-time highs, while a failure could trigger profit-taking. This is the next big plot point in our thriller. On the bullish side of the ledger, many argue that Ethereum's transformation is structural, not ephemeral. With so many long-term holders and institutions on board, the narrative is that ETH is maturing into a quasi-reserve asset. It's not just the gas token for blockchain anymore. It's taking on qualities of a scarce commodity or even a dividend-paying stock. Major companies and funds are now openly adding ETH to their treasuries, betting on its future role. Crucially, the price surge is self-reinforcing. Consider the ETF effect. Nearly $10 billion of fresh money flooding in has a multiplier impact. Every ETF share bought forces the fund to acquire ETH, lifting the market. In fact, analysts note that Ethereum's run has become a dual-engine rally. One engine is the tidal wave of institutional flows. The other is the engine of on-chain growth and usage. It's like a plane with two powerful engines in sync, rather than one. Indeed, the broader structural story has gained traction. Imagine Ethereum as the Internet of Finance, whose infrastructure is now built, with each upgrade adding new lanes. Staking and burning have turned it into a digital commodity with yield. Scrolling through block explorers, one sees not just random trades, but the digital footprints of applications carrying real economic value, billions in DeFi, content platforms, gaming, and more. CryptoQuant's data underline that this isn't a hollow hype cycle. ETH is increasingly behaving like an economic commodity, where usage drives value. Bulls point out that if this trend continues, if Ethereum truly remains the workhorse of decentralized finance and beyond, then today's valuation may not seem so extreme. On the flip side, the old market adage still holds. What goes up can come down, often suddenly. This rally has certainly been fueled by euphoria and momentum, which are inherently fickle. Every major crypto bull market in history ended in a correction. So far, Ethereum's rise has invited increased volatility. Already, after breaching $5,000 one day, the price reversed 4% in 24 hours despite continued inflows. That quick whipsaw is a taste of what could happen on a larger scale. After all, if even a small delay in buying or an unexpected sell order can wipe 4% off in a day, imagine what might happen if sentiment truly sours. Thousands of leveraged longs and vast options positions are out there waiting on triggers. Each support level or psychological round number can turn into a battle zone. Thus far, the technical trend is up, but one negative surprise and exchange outage, a large whale moving coins, etc., could cause a much larger tumble. Adding to the complexity is the macro backdrop. Crypto is not in a vacuum. Investors have piled into Ethereum, partly expecting easier money from central banks. The U.S. Federal Reserve is widely expected to cut interest rates by 25 basis points in mid-September 2025, which in theory fuels risk appetite and crypto flows. Some attribute part of the rally to this anticipated liquidity. However, any deviation, for example, if inflation comes in hotter than expected or a geopolitical crisis erupts, could quickly change the game. Crypto's risk asset nature means it often moves with global financial tides. If markets tremble, crypto tends to tremble harder. In this scenario, even minor macro surprises could spook the bulls. And then there's the ghost in the room, regulation. Ethereum's rapid ascent has drawn the eye of authorities. Unlike Bitcoin, which regulators generally treat as a commodity, Ethereum's tangled web of tokens and its transition to staking leaves open questions. In 2024, consensus alleged that the SEC was trying to treat ETH as a security, a claim that, true or not, underscores the ambiguity regulators hold. A single enforcement action, or a new rule, could jolt the market. Imagine if regulators suddenly classified staking products differently, or impose new KYC/AML rules on ETH trading. Even proposals abroad, like Europe's MICA, could indirectly affect investor confidence. This layer of uncertainty means that as much as numbers drive price, a policy change could flip the story on a dime. Technically, the charts are taut with tension. In mid-September 2025, Ethereum was trading around $4,650, perched on a narrow band. A crucial support has formed near $4,664. As long as that holds, the bulls claim the path to $5,000 is clear. Traders often mention retesting the old high of $4,957, just shy of $5,000 as the next step. If ETH decisively breaks above that level, it could unleash a cascade of buying toward $5,000 and beyond. But if $4,664 cracks on a bad day, the next major support isn't until about $4,211. In practical terms, the entire immediate trend hinges on these levels. Chart analysts note the price has formed a steep ascending wedge, a bullish continuation if it breaks out, but vulnerable to a sharp reversal if it fails. It's a classic technical cliffhanger. Either this trend continues up, or it snaps and triggers a much different price regime. Underneath the charts, the speculative apparatus hums. Institutional trading desks, high-frequency bots, and margin accounts are all laser-focused. For example, CoinMarketCap reported that in a single 24-hour window, $49.4 billion of Ethereum futures contracts changed hands, even more than the $42.9 billion in Bitcoin contracts. That's raw speculation volume on par with a full-blown mania. During a recent 10-day span, $1.39 billion flowed into Bitcoin ETFs, while about $668 million flowed out of Ethereum ETFs, suggesting some rotation or hedging between the two. On the options front, implied volatility is surprisingly tame, indicating traders have largely priced in the Fed move and are not betting on a massive crash just yet. Still, these markets of leverage and contracts mean that any shift can get magnified. In short, the speculative infrastructure can amplify any hint of change. Is Ethereum alone in this race? Not entirely. Other blockchains have seen flux, but as of now, none has dislodged Ethereum's primacy in DeFi and tokenization. If a competing platform took off suddenly, capital might shift. But currently, it's Ethereum that receives most institutional focus, especially in regulated products. That dominance, being the go-to smart contract chain, is a strength for now. However, a sudden disruption, say, another technology breakthrough or regulatory-friendly move for arrival, could inject doubt into the narrative. All of these factors. On-chain data. Macroeconomics technicals boil down to psychology. Investors are torn. Bulls see headlines of $10 billion flows and call Ethereum the Wall Street token, praising its integration into the financial mainstream. Bears see a classic bubble, parabolic rise ripe for a fall. Social sentiment is through the roof, a sign of FOMO, yet many pros remain wary. This tug-of-war of sentiment adds to the suspense. It's like watching a crowd at a thriller movie. Some predict the hero will win. Others fear the villain will strike, in terms of valuation. Ethereum trading near $5,000 implies a market cap approaching $2 trillion. That's eye-popping for a niche digital asset. By traditional metrics, it appears extremely expensive, higher than almost any company in existence relative to earnings. But crypto valuations aren't traditional. If you believe Ethereum is the backbone of a multi-trillion-dollar DeFi economy with limited supply, the high price is part of the story, not all of it. In other words, bulls argue Ethereum's value isn't measured by earnings, while bears counter then, what is it measured by? That philosophical divide keeps the debate alive and the tension high. For now, the only certainty is uncertainty. This narrative-driven rally has amassed incredible momentum, record staking, whale accumulation, blazing usage, and enormous capital flows. Yet volatility stands ready to make any move swing violently. It is a classic high-risk, high-reward scenario. Traders on edge consider every chart pattern and tweet as a possible clue. Is Ethereum building a lasting financial infrastructure, or building a castle of cards? The next chapters will reveal themselves soon. A decisive break above $5,000 could mark a new investment paradigm and send Ethereum even higher. A failure to hold current levels could usher in a swift correction, reminding all how quickly fortunes can change in crypto. In this thriller of markets, the ending is still unwritten. Every data point, from staking totals to ETF flows, is a clue. And for anyone watching this real-time drama, one piece of advice stands out. Fasten your seatbelt. The ride to $5,000 is far from ordinary, and as always, in crypto, the only guarantee is that nothing is guaranteed.